So the webinar today is retirement ready or not? Here it comes. And are you ready? So we try to address the four toughest questions that everybody should have the answers to. And the first one is, what rate of return do you need to earn right now with what you're doing in order to have your lifestyle in retirement the same as it is today? We are big proponents of trying to maintain your lifestyle. There's a big rule of thumb out there in our industry of 60% of pre-retirement income. We're not fans of that. Why would you want to cut your retirement income by 40% or your standard of living by 40%? We try to get you as close as possible to 100%. Sometimes it takes a lot of work. Sometimes it doesn't, depending on the situation of the client. But we're really focused on getting that standard of living or maintaining it. The second question you should know the answer to if you're dealing with an advisor is, how much do you need to be saving to maintain your current lifestyle in retirement and for your life expectancy? So how much more do you have to put aside? You should know the answers to these questions, or your advisor should, and it shouldn't be rocket science or even something that has to be worked on too heavily. The third toughest question is, how much longer will you have to work? So we've talked about this in many radio shows and webinars. Retirement is just a number. If you had enough capital to maintain your lifestyle in retirement at age 55, why would you wait to 65? Unless you really love your employment, you might work till 70 or longer. But if you have that ability, you know that you can walk out at any time. And that's what we try to focus on, is how much longer we have to work. Sometimes it's 55. Some people say, I want to get out at 65. And sometimes that may not be doable. It may have to be 68 or 70. So these are the numbers you should know. And again, it all comes back to maintaining your current lifestyle through retirement. The fourth question, and this is the toughest one out of all of them, is how much do you have to reduce your standard of living in retirement, given the capital you have now, and for it to last through your life expectancy. So this is a really hard one. Do you have to reduce your lifestyle? That's why we're not big fans of the 60% rule. You're already cutting it down to 60%. And then look what's happening this year. Inflation in the States is 8%. We're clipping along at almost 5%. All of a sudden that 60% is coming down to, in the 50s. So there's already a built-in equalizer or detractor from your income in retirement, which is inflation. So Tony, let's move forward here. And
I just wanted to add one thing. I just want to add one thing on that. Also, how long are you planning on living? None of us know what our expiry date is. We aren't born with a barcode on our chest saying we're good to this day past expiry. So trying to make sure the money lasts you through your retirement is also, it's a big guess at what number we have to use for retirement. So
yeah, and I'll just throw one more thing on top of that. A lot of people are saying, well, look at my gas bills or hydro bills right now. If you think that's bad, wait till you see what assisted living costs. I mean, these days it's already 5,000 to 7,000 or even 10, depending on what you need or what you require. So let's move forward here and let's do a case study. So this is the 15-minute conversation we run through with clients about the four toughest questions. And Tony, we've used this module many times with prospective clients and people that have become clients. What is your experience on a scale of 1 to 10? What is your experience of clients saying they're retirement ready between 1 and 10? What's your experience?
A lot of people believe they're a 6 or a 7, and that means that they're fairly comfortable that they're on track and pacing correctly towards retirement.
Okay, so we'll just tick off 6 here just to make it easy. And now we're going to move into assumptions. So I'm going to ask you for some inputs here. These are pre-populated from another scenario that was run earlier. So what age do you want to start at, Tony?
Let's go 45.
45. Retirement age 65 is acceptable?
Yeah, that'll be 20 years before they start retiring.
Okay. And life expectancy 83, or should we change that?
Change it to 90.
90. Okay.
So if you notice, you're going to be living a lot longer. You got 45 years from now to before your expiry.
Yeah.
So 45 years, and you got 20 years before retirement. So you're going to be living 30 years past retirement age.
So for our participants, we have life expectancy here. If you don't know your life expectancy or would like to know, a number, we do use actuarial tables, and we can run it on a single, joint, or both basis. There is a difference between both and joint. For simplicity reasons, we're just going to use a single life expectancy to age 90. Current income, Tony, what would you like to enter here?
Let's put 80 in.
80,000. And annual savings?
Let's 10%, 8,000.
8,000. Okay,
Yeah.
and for participants, inflate means inflating the annual savings. We're not going to do that because usually people just have a flat savings rate. They usually don't keep pace with inflation. Very few do. There are, I guess, very few people do, but generally people just do a flat savings rate. How much would you put for accumulation in terms of what they have at age 45 in savings, Tony?
Let's put 70,000.
70?
Yeah, 70.
70. Okay. And then in terms of accumulation, this is the interest rate that they'll be earning during their working lives before retirement. Where do you want to put that at?
Well, I know a lot of people have been talking about how great they've done in the last few years, and they're so excited about, wow, I did X amount and it's really great and it's so easy to make money. Well, the market seems to have a way to revert to the mean, meaning that it claws back some of those great gains. So over time, I would say if we aim at 5%, would probably be conservative.
Okay. This is just saying that these are hypothetical numbers. It's just saying that we're changing the assumption from 6 to 5 rather. Oops, sorry. Distribution will keep the same.
Yeah.
Okay. Inflation will peg at 3%. Again, we have the ability to look at the inflation tables with our prospective clients during the 15-minute conversation. So as an example, here's our inflation table. It goes back to 1960 all the way through to 2021. So from 1960 to 2021, inflation averaged 3.69%. So just to keep the numbers round and easy, we're just going to use 3%, but we can choose any period, any start and stop period for our clients and prospective clients. Tax rate, we can include that to make things simple. We're going to keep it at 0. It tends to muddy the waters a little bit when we're in a webinar situation. Now, Tony, let's move on to defined benefits. What would you consider a defined benefit?
Well, most people don't have any pensions anymore. So let's just look at Canada Pension, CPP, and
Okay.
let's just use round numbers, 12,000. I know for males, it's usually higher than for females, but if we just use a round number, that'll be fine. Index in COLA, it's the cost of inflation, and it's 2%. And let's go from 65 to 90.
Okay. Now we do have a taxable piece here. That's not the tax rate. It's whether or not this is a fully taxable benefit. It is, but again, we're keeping taxes simple. Let's go to the next one. OAS, correct?
OAS. I'm just using round numbers again. Let's say 6,000 there per year. The COLA, which it's the cost of living adjustment, 2%. And again, 65 and 90.
And we'll save that. So we do have other modules or other additions that we can pull in. So future assets could be an inheritance coming in or a sale of a business. Future expenses could be anything from a car to a second home to retirement living. And finally, legacy is if you want to leave a legacy for your loved ones, so essentially a estate. So current lifestyle is $72,000. How did we arrive at that number? Keeping it simple, it's your current income, which is the 80,000 right here, less the tax, we left that at 0 for now, and less your annual savings of 8,000. That's how we got to $72,000 in today's dollars. This one we will increase by the inflation rate of 3% because we want to know how much money you need in future dollars to maintain your current lifestyle. So Tony, if I missed anything, did you want to add anything in here? How are we doing?
No, a future expense, not only retirement living, but medical care or assisted living if you need it. There's a lot of different things that can go in there. And a lot of people forget that you may own your home, but even if the house is paid for, you still have expenses on that. It's called a housing expense. It never goes away. Whether you're renting somewhere or you're living somewhere in your own house, you still have a housing expense for the fuel, for heating, utilities, and property taxes and maintenance. So those are different numbers that we could throw in, but for today's, we're not going to do that. So I just wanted to mention that.
Yeah, we can go into a lot of detail if we need to when we're one-on-one with a client.